Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. If you didn't check out my interview last week with Pierre Poilievre, go and check that out. A deep dive conversation on everything you need to know about the Canadian economy, housing, blah, blah, blah. But I want to touch this week, well, there's lots to touch on, but we had the Bank of Canada come out with an update to their financial stability review. We had the updates to the mortgage stress test. We had national housing statistics come out. We had inflation data, just a whole bunch of data coming out this past week. So lots to talk about. But I want to frame this up by going back in time and jumping in the back to the future here, by going back and looking at some comments from Bank of Canada Governor Tiff Macklin, who made these remarks at the very beginning of July. So let's clip to Tiff right here.
Our message to Canadians is that interest rates are very low and they're going to be there for a long time. We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
So Tiff basically goes on to say, again, if you're a Canadian, rest assured, take on as much debt as you can. We will keep rates extremely low. We need you, Canadians, to borrow as much money as you can to sustain and try to drive some economic growth, from keeping us from going into an economic recession, depression, whatever you want to call it. And so what happened? We obviously saw the Bank of Canada, $5 billion per week of QE, money printing, whatever you want to call it. And the housing market took off, right? I mean, mortgage rates collapsed down to a 5-year fix going down to 1.5%. People aggressively borrowing money, record home sales across the nation, record home prices. All we have to do is look at the national statistics, where actually just came out here for the month of April. So, national home prices up 23% year over year, 23% nationally. Now, keep in mind, before everybody starts to get smart with their comments below, this is a hedonically adjusted index. This is taking the composite of all the properties that are sold and spitting out a number. So it's not the average sales price. The average sales price was up like 35, 36% year over year. So that's even worse. So just the average, the typical home in Canada increased nationally by 23% at a time, but again, when you had record unemployment and basically a temporary halt on immigration. So the fact that we're seeing 23% growth. Now, keep in mind, this is a lagging indicator, as I've talked about many, many times. What you're likely to see next month is national home prices ticking up to, say, 25% year over year in the month of May. This is the fastest pace of home price acceleration that we have ever seen, even surpassing the 2016-2017 bull market. This is not healthy. And so what we're seeing now is, ironically, the Bank of Canada now comes out and says in their financial stability review, well, we're really concerned about household debt, and the housing market is showing signs of exuberance. Canadians need to be cautious. He says Canadians, if you're just simply banking on your ability to refinance your home and pull credit out or pull equity out in 5 years, you can't bank on that. So he's trying to walk back the markets, and I find it rather hilarious, because I think someone made the comment, arsonist worried about neighborhood burning down. Buddy, it was like, Tiff, you did this. This is you did this. You said back in July, you told everybody to go and borrow money. What did you think was going to happen? I mean, you've got rates right now at zero, and you're running $3 billion as of right now of QE per week. I mean, this is on you. You are the candy man. And so now if we kind of look and say, okay, well, so what now, right? I mean, basically what I'll say from an analytical perspective is this is essentially the Bank of Canada jawboning the markets, right? So what they're trying to do through all of this, it's called essentially forward guidance, is they're trying to walk back the markets. They realize that it's gone too far, too quick. And so what you do is you say, okay, listen, we need to caution markets. So as opposed to coming out with messaging like we did back in July, we're going to come out with new messaging that says, hey, listen, you guys need to be cautious. We're going to start watching this. We're watching, interest rates will be going up here eventually. And they've actually, in their monetary policy report, back in July, they said, listen, we're not even going to raise rates till at least 2023. Now it's 2022. So they're trying to walk it back. And the reality is they're trying to do this without having to raise interest rates. Because as I've said before, the reality is they don't really have any ability to raise interest rates. There's too much debt in the system. And people say, well, hold on a minute. Didn't you not see inflation? Inflation metrics came out this week. So Canada's inflation rate's running at 3.4% year over year. And obviously surpassing the Bank of Canada's 2% target. Now, again, the bank says, don't worry. It's transitory. It's going to go away. So keep in mind now, so it's 3.4% that the inflation rate. So they say, well, aren't you going to raise interest rates? That's certainly what the market thinks. But the reality is the bank, while they might get away with a hike here, maybe two, the next year or two, I don't know. What they ultimately need to do is they need to keep real rates negative for a long time, probably 10 years, maybe longer. Because how else do you eviscerate a mountain of debt? There is no level of society that can sustain higher real interest rates. So you cripple households, you cripple corporations, and the government, the federal government, which is running these massive, unbelievable, unprecedented deficits, that budget is entirely predicated on ultra low borrowing rates. And if we look now, so if we had inflation came out at 3.4%, the Bank of Canada's overnight interest rate is 0.25%. So if you take the rate of inflation, 3.4, and you subtract it by 0.25, that brings you to a real rate of interest of negative 3.15%. Negative 3.15%. So the real cost of money today is negative 3%. Of course, people are blowing their brains out on debt. Again, if the Bank of Canada, which has been cautioning about rising debt loads and unsustainable house prices, if they were actually meaningfully concerned and wanted to do something about it, they could raise rates tomorrow. You could start raising. Go take the overnight rate from 0.25 and put it to 2.25 and let me know what happens to housing and to these debt loads. I can guarantee you there will be a deleveraging cycle. But the Bank of Canada and nobody else wants to obviously stomach that pain. Nobody wants to do anything about it. So we're trying to jawbone the markets down without actually having to raise interest rates. And ironically enough, is you can actually see that the other levels of policymakers are coming out and trying to do the same. So we had an update last month. OSFI came out and says, listen, we're going to increase the mortgage stress test for uninsured mortgages. We're going to increase it by, I believe it was 25 basis points. So what it did is it essentially reduced borrowing power by 4.5%. That was for the uninsured mortgage market. So OSFI this week says, yeah, we're confirmed. We're going ahead, officially confirmed it. And the same day, Krista Freeland, the finance minister, came out and says, we're going to do that for insured mortgages. Because remember, the federal government For insured mortgages, which is less than 20% down, the federal government insures those mortgages. So they are responsible for those regulatory changes. So it was Krista Freeland as finance minister. It was her job and her responsibility. So she is following OSFI. So now you have the stress test going up for both insured and uninsured mortgages. This is now unavoidable. So borrowing power again is being reduced by about 4.5%. That's what they're trying to do. So they're trying to slowly walk back the markets without doing too much. Just a little tighten here, a little tighten there. Just again, I mean, national home prices are up 23%. Clearly something needed to be done. Now, where I think they've botched this policy, in my opinion, and again, agree to disagree. I'm sure there will be plenty of comments on this below. What's happening internally is a lot of banks, some of the banks, I should say, but others will follow, are altering debt servicing requirements for the uninsured mortgages. So they're trying to basically offset the stress test. So they're saying, well, hey, if you're strong credit worthy, which is like, hey, you make 120 grand plus household income, again, not like huge hurdle requirements, but stronger credit, we will allow you to increase the debt service ratio, and this will essentially offset the stress test. They are not doing that for the insured mortgages. So now, if you remember, who are the people that are using insured mortgages? It's largely first-time home buyers that are scraping together all of their shekels in order to just squeeze on the property ladder because they have been squeezed by society. And so you're tightening credit for that first-time home buyer that is just barely trying to get on the housing ladder, that is obviously falling further and further behind because you have this large wealth gap that is growing. Because again, think about QE and low interest rates benefit who? They benefit asset owners because they are closest, they have the assets and they are closest to the credit tabs. So you're tightening the credit on these first-time home buyers. Meanwhile, for the investors, you're not really actually tightening credit. The reality is like a little stress test increase is not actually going to marginally impact an investor. If an investor wants to go and buy a second or third property, chances are they have the capital. If they need to come up with a slightly large down payment, they'll do that. And so what you're going to see is this policy, in my opinion, is just a larger wealth transfer where you're going to shut out more first-time home buyers from the entry-level market, and you'll have more investors coming in to buy up that entry-level product, which will then probably rent out to the would-have-been first-time home buyer. Again, agree to disagree. That is definitely what these policies are going to do. But this should not come as a surprise that policymakers have been botching, the housing file for several decades now. Anyways, I'm going to leave you with one last thing, just to sort of summarize all the policymakers' decisions. Are they doing the right thing, the wrong thing? Well, probably some of it starts with the data. The federal government, official statistics, official inflation data, housing and shelter costs per the inflation data increased 3.2% year over year. The government agency, which is responsible for collecting inflation data, thinks housing and shelter costs are only up 3.2% from last year. And that's all I need to say. Have a good weekend, and we'll see you next week.